All right, so let's talk about Chapter 13. Um, there will probably be three parts to this. I've already put up Part B, um, and this first part's pretty long, so I'll probably mark this as Part A1 and AB. All right, so current liabilities and contingencies. Part B is dealing with contingencies. So, what are the characteristics of a liability? Well, a liability is an obligation, right, that a company has. Normally, you think that this obligation must be paid back in cash, but that's not true. It could be paid back uh, as with assets, or it might be paid back with providing services, but usually it's cash. Also, the liability doesn't have to be represented by an agreement, nor does it have to be legally enforceable, although usually it is. And you might not even know the precise timing of repayment, such as when you have a contingent liability that seems to be probable, and you can estimate the amount. But the main thing is that it's a future sacrifice of economic benefits. It's based upon or arisen from present obligations, and it resulted from past transactions or events. Now, current liabilities are liabilities that must be obligated, or an obligation that must be satisfied within 1 year or the firm's operating cycle, whichever is longer. But usually for most companies, it's 1 year. It must be satisfied from current assets and or satisfied by creation of other current liabilities. Usually you're satisfying it with current assets. But let's say never mind. Anyway, recording current liabilities. Liabilities, as you know or will learn, should be recorded excuse me, at their present values. I guess we've talked about that. However, these are current liabilities that are going to be paid in 1 year or less, usually. And so here we have an exception to the whole present value situation. So current liabilities, because they're paid within 1 year usually, are recorded at their maturity amounts, or if you will, face amounts, face value. So if you get an invoice for a certain amount, you're going to record that at the amount of the invoice, not the present value of that, because you're paying it within such a short amount of time. So some examples of current liabilities would be the main one, accounts payable. You might have short-term notes payable, something called commercial paper, income tax liabilities, dividends payable, and then accrued liabilities. So the most common and usually the largest amount of current asset you're going to have comes from transactions the company has made with suppliers. So accounts payable usually is the largest current asset. And these are obligations to pay back within a very short period of time, usually within 30 days. And you're buying stuff from your suppliers on credit. So the key accounting considerations are determining the existence of the obligation and then simply recording that obligation in the appropriate accounting period. Note here, the great thing about accounts payable is these are non-interest bearing, and of course they're reported as at their face amounts, but this is a major source of financing for companies. So it's kind of the best of both worlds. Now, there's also something called a trade note payable. Usually these are longer term obligations. Usually accounts payable, yeah, you usually have to apply to become a credit customer with the supplier and you agree to their terms overall. But after you apply, it's not like you're agreeing to terms on every invoice separately. You just kind of, when you apply and sign the application, that you'll agree to the credit terms. There's no other writing other than the invoice that you get. With trade notes payable, you have a document called a promissory note that describes the obligations of the parties, signed by both parties, has the face amount, the principal amount, the term of time this note will be paid, usually on a monthly basis. Not always, but usually. These are usually of longer duration than accounts payable. And the main thing is these require payment of interest on the balance. So that's the big difference, is the interest payment. Much more formal. So here's an example of the presentation in the balance sheet by General Mills. Notice you've got accounts payable on top. That's usually the first item in any balance sheet you'll see. Notice here the second item, current portion of long-term debt. Now, long-term debt is long-term debt and normally would not be a part of current liabilities. However, note that most long-term debt is paid monthly. You're making monthly payments. And those payments that you're going to make within the 12-month period during the respective accounting period are considered current liabilities. And so that's why you have this item called current portion of long-term debt. And then next you have notes payable. These are obviously, since they're in current liabilities, these are notes that are going to be paid back within the accounting period. And then you got this big old other current liabilities that has all kinds of accrued liabilities in it and maybe some other stuff. Who knows? You'd have to go to the notes to get details. Here's part of the notes. So it indicates the weighted average interest rate on commercial paper as well as obligations to financial institutions. So notice it's a they don't I mean, they've got probably so many of these that there's no way they could report it all. So they just use a weighted average interest rate because all these obligations have different interest rates, I'm sure. All right, so which of the following statements is true about current liabilities? Current liabilities are obligations payable within 1 year or within the firm's operating cycle, whichever is longer. True. Current liabilities are ordinarily recorded at maturity value rather than present value. True. And what is that second or third one? Well, that's true too. So it's all of the above. All right, let's talk about short-term notes payable. These are temporary financing that the company obtains from a bank. It's almost always formalized through what's called a promissory note that has all the terms of the note. Usually because they're less risky, they're being paid back sooner, the lower they afford the company, the debtor company, lower interest rates than long-term debt, much less risky for the bank. And so it allows them some flexibility. Of course, they could always turn this into a long-term debt if they can find favorable financing alternatives. Now, the short-term notes payable can be one of, well, the financial alternatives can be one of several options that we'll look at. Commercial paper is a possibility. That's essentially selling short-term promissory notes to companies, usually other companies who want to invest in it. Unsecured loans, if possible. Usually that's going to come from inside the company from some investor. Credit lines are a big one. And of course, could have secured loans. So one of the ways that a company can have alternative financing, or at least one of the options that they have for short-term uh, payables, is a line of credit. And so this is agreement to provide short-term financing with amounts drawn or withdrawn by the borrower only when needed. And so even though the loans are short-term, the amounts borrowed are paid back frequently. These usually are continuing agreements, meaning as long as they meet the credit terms, the bank supplies the credit lines. Now, these lines of credit can be either non-committed or committed. Committed is a more formal agreement. The company has to pay a commitment fee to the bank to keep the credit line amount available to the company, and the company may have to maintain a compensating balance with the bank in order to keep it open. With a non-committed credit line, it's simply a verbal agreement, so it's not a formal agreement in writing. And the company can borrow up to a certain amount without any formal loan procedures. Beyond that, they've got to sign a formal agreement. So probably most credit lines are committed, but certainly if a company has really excellent credit, they might be able to get this without the formal agreement. So here's a disclosure for IBM. And so anyway, note they have the ability to borrow up to $10 billion on a revolving basis. So what happens is they borrow on their line of credit when needed, what they would call drawing down the line of credit, and just to fulfill their short-term cash needs to meet other obligations. And then when they get excess cash, they uh, pay back on their line of credit. That way they free up the line of credit for future use. Now, of course, whether it's committed or non-committed, if you draw down on your line of credit, you're going to pay a certain amount of interest on the amount you borrow. And so you're returning or you're giving the lender a return on the money that you're borrowing from them. And of course, it's going to be whatever percentage rate that the parties agree to, based upon that percentage times the number of months that you borrow times the fraction of the year you borrow it. So here's an example. On May 1, Affiliated Technologies, Inc., a consumer electronics firm, borrowed $700,000 cash from First Bancorp under a non-committed short-term line of credit arrangement and issued a 6-month 12% promissory note. Interest was payable at maturity. Very unusual, but it's such a short amount of time, I guess so. So 6 months, it's all within the same, well, you have to assume that year end is 12/31 here, so they don't really tell you that, but that's the assumption, I believe. So they're going to pay a half year's worth of interest on this loan. So since it's 12% annualized, what you're really paying is just 6% for 6 months. So you're going to pay $42,000 of interest. So you're going to debit cash initially and credit notes payable. And then on November 1, when you pay this, you're going to debit notes payable, credit cash, and also you're going to debit interest expense for the amount of interest that you're paying. And so the interest expense, like I said, is $42,000. The notes payable you're backing out, and then the amount of cash you're paying is both the notes payable and the amount of interest of $742,000. Now, as we've seen on the asset side, you can have a non-interest bearing note, but even though it's non-interest bearing, there still is imputed to it an interest rate, and it's usually the market rate at which this loan would be borrowed. And so here, same issue, except this is a 6-month non-interest bearing note with the market rate or the discount rate being 12%. And so in the initial recording, you're going to record cash at $658,000. So it's going to be $700,000 less the amount of interest that's going to be paid. You're going to initially record that $42,000 not as a receipt of cash, but as a discount on notes payable. So it's a contra liability account, if you will. It makes the face value of the notes payable $700,000 less the discount on notes payable. And then when you pay this, you're going to, of course, back out the note payable. Well, first of all, you're going to record interest expense of $42,000 and back out the discount on notes payable. And then you're going to back out the payable, and you're going to pay $700,000. Now, the authors note here that because you're only receiving $658,000 effectively here, but you're calculating interest on $700,000, your effective interest rate is actually higher than 12%. Of course, that's an annual rate. So here's how you could figure that out. $42,000 interest for 6 months divided into $658,000 borrowed equals 6.38% for those the use of 658,000 for 6 months, but you're paying back 700,000, right? So to figure out the annualized effective interest rate, it's simply twice as much, 12.76. So as they know, when interest is discounted from the face amount of a note, the effective interest rate is higher than the stated discount rate. Now you could have secured loans, and usually you think of more long-term obligations being secured loans, but you could have a credit line that's secured, most often secured by inventory or receivables. So that acts as your security. And so pledging accounts receivable, what you're pledging is the receivables. It serves as your collateral. Now normally you don't identify any specific receivable. You could, but often it's kind of what they call a rolling pledge, meaning all accounts receivable at any time during the existence of this obligation secures the debt. The other way you could do this is called factoring receivables. That's when the company sells the receivables to a third party outright. Usually the factoring fee is pretty steep. You've got to really want to sell your receivables to do this, because they don't pay you the face value of your receivables to do this. Commercial paper, these are unsecured notes sold by the company. The denominations are usually $25,000. The maturity dates range anywhere from 30 days to 270 days. So very short times. Anything beyond 270 days would require what's called a registration statement. So much more disclosure requirements involved, and you have to register those with the SEC. So usually 270 days is the cutoff point, because companies want to avoid that extra paperwork with the SEC. Notice this, and we've seen this before, interest is often discounted at issuance. So even though the sold in minimum denominations of 25,000, usually that's discounted. So they're actually receiving less than $25,000 because the buyer of these unsecured notes gets the interest up front by paying less than $25,000 each for these notes. They're receiving interest payments up front. Now, usually these commercial papers are issued directly to the buyer, and the commercial paper is backed by a line of credit with a bank. So you've actually got three parties involved here. And because these unsecured notes are backed by a line of credit with a bank, it allows the company to sell these unsecured notes at a lower interest rate than they otherwise could issue them at. Otherwise, issue them. Take off the at. All right, so Jamal borrowed $100,000 on July 1, 2018 and signed a 4-year note bearing interest at 8%. Interest is payable in full at maturity on June 30, 2020. Jamal should report interest expense at 12/31/2018 of, well, annually it would be $8,000, but you've only got 6 months accruing here, so it would be $4,000, right? Accrued liabilities. It's all those expenses that you've incurred. You're accruing these at the end of the fiscal year. You come up to the fiscal year and you go, okay, what else do I owe? Taxes payable, things like that. Salaries and wages payable, interest payable, whatever you got, you've got to accrue a liability for them, even though you're not going to pay it until sometime in the next accounting period. Note that you usually don't list these separately. You lump them together. It was these accrued liabilities were in that other category that we saw earlier. So here's an example of a note with accrued interest. They borrow $700,000 on May 1. 6 months, 12% promissory note. Interest payable at maturity. Assume the fiscal period ends June 30th, 2 months after the 6-month note is issued. So you're going to have to accrue 2 months worth of interest. So that's your initial entry, receiving the $700,000. But the accrual of interest, you're going to record $12,000, right? Or $14,000, excuse me. And then when you pay the note 4 months after the end of the year, you've got to accrue an additional 4 months worth of interest expense. Then you're going to back out the interest payable of 14. You're going to back out the notes payable of 700, and you're going to record cash as your credit for $742,000. Pretty simple. All right. Another, and we've dealt with this for salaries and wages payable. You would have to record any not paid. They go into vacation in 6 days and all this stuff. I don't think I ask anything on it, so let's move on. Liabilities from advanced collections. All right, so you collect money ahead of actually earning the revenue. Prepayments, deposits, gift cards, and collections for third parties, such as sales tax. And so you're receiving the money ahead of time. You're going to have to possibly pay some of these back. Either possibly or definitely going to have to pay some of these back. All right, so refundable deposits. You're going to record an obligation at the time of receiving the deposit. So we have an example here where this company sells combustible chemicals in expensive reusable containers. They collect a deposit on those containers, and in total they collect $300,000. Now these deposits are forfeited if the containers are not returned within 1 year. 90% of the containers were returned, so $30,000 worth of deposits were not returned. Well, the containers related to them were not returned. It also says deposits charged are twice the actual cost of the containers. And so here, because 10% of $300,000 of containers were not returned, they get to book that as revenue. And of course, they have to deal with the inventory as well. And so, because that would, even though these containers are being used by their customers, this chemical company still records these containers in their inventory. But because they haven't been returned after 1 year, they've got to take it out of inventory. So that's the second part of this. So when the deposits are collected, and again, you would do so as they're collected, but they just lump them all into one lump sum, 300,000, and your credit is going to be to refundable deposits, and of course, when the containers are returned, they're going to have to issue cash to the customers. So there's your accounting for the 90% that were returned. And as far as the ones that were not returned, their deposits were forfeited. And so you have to back out the deposits that were before refundable and record revenue on the sale of containers. And so because you're booking this as revenue based upon a sale of containers, you've got to deal with cost of goods sold and taking out of inventory those containers. So that's the second part or third part of this. It's going to be 15,000, exactly half of the deposit. So cost of goods sold 15 and credit taking out of inventory. Now you can have other types of advances. Examples of this, I mean, the most common is somebody doesn't pay you, well, you sell to someone who is not credit worthy. And so you're going to supply a good or service in the future, but you require an upfront payment. That would be the most common. And they don't really mention it here, but I guess we could put it under special order deposits. Special because they're not credit worthy, otherwise you'd sell them on credit. But some others are gift certificates, magazine subscriptions, layaway deposits, airline tickets, season tickets as well, like to sports venues, sports teams. So here's an example of a company that sells magazine subscriptions. So they collect money up front for the year's subscription and they're going to recognize revenue over the term of the subscription as they earn it. So they collected $20 million in subscription sales during the first year of operations, and at the end of the year, the average subscription was 1/4 expired, so they're going to recognize revenue of $5 million. First, they're going to recognize the advance when they collect it, so this would be the collective sum of all monies collected for subscriptions. And so they record a deferred subscription revenue, and then as they earn it, they're going to take it out of deferred subscription revenue and recognize subscription revenue. Also, as far as gift cards are received, cash received on the sale is recorded as deferred revenue and then recognized as one of two things happens. Redemption of the gift card is the usual thing that happens, and so when a gift card is redeemed, the company who sold it is going to recognize revenue. The other part of this, where they would recognize revenue, would be when you have what's called breakage, which is there is the company determines that there's a remote probability of redemption. So enough time has lapsed and the card has not been used for whatever reason, gets lost, gets stolen, gets destroyed, whatever. And so here we have an example of that. During May of 2018, Great Buy sold $2 million of gift cards. Also during May, 1.5 million of gift cards sold in prior periods were redeemed by customers, and 1 million in gift cards sold in prior periods expired unused. And so you got several different things going on here. First of all, you've got the sale, so you're going to record cash of 2 million and deferred gift card revenue of 2 million. And then on the prior period stuff, you're going to recognize gift card revenue, or whatever they might call it here. You're going to back out deferred gift card revenue of 1.5 million and recognize the revenue. And as far as the broken part, same thing. Lastly, I think, this went a little bit quicker than I thought we would. We're not quite through. Collections made for third parties, anytime you have like withholding taxes, Social Security taxes, insurance, contributions to retirement plans, sales tax. Those are things that you are taking out of the employee's paycheck, or in the case of sales tax, the customer's proceeds, and you're going to pay it over to someone else, another party. So here, let's say we've got a state sales tax of 4% and a local sales tax of 3% on a sale of $100. You're going to have to charge the customer actually $107. So you're going to collect $107. But when you record, you're going to record receiving $107. You're going to record sales revenue of $100. But you're going to have also an obligation called sales tax payable of $7. Then when, of course, you pay that, you're going to back out the payable and pay cash of $7, along with probably a whole bunch of other sales tax payable. All right, so Perkins accepted an advance of $2,400 on December 1 for providing IT help desk services for the following 6 months. Perkins estimates fulfillment of this performance obligation based upon the passage of time. On December 31, Perkins will make an adjusting entry that includes a credit to revenue of, so you're accruing 1 month of revenue on $2,400. So 2,400 divided by 6 is 400, so D. Piece of cake, right? Gift cards. Ling sold $30,000 of gift cards during 2018. Also during 2018, 25,000 of gift cards were redeemed, some of which were sold in 2018 and some which were sold in the prior year. Ling also concluded that $2,500 of gift cards sold in the prior year would never be redeemed, and Ling finished 2018 with a balance of $17,500 in deferred revenue gift cards. There's a lot of information there. Ling should recognize revenue in 2018 associated with gift cards of, well, there's a lot of things going on here. The $30,000 that they pay or received in gift cards is not the answer. It's the $25,000 that they redeemed plus the $2,500 that they uh, or have determined will never be redeemed, right? So 27,500. So here they ask the question, given a choice, do you suppose management would prefer to report an obligation as a current liability or non-current liability? Most would choose non-current because it doesn't, it's not, well, it says the reason is that in most settings, outsiders consider debt that is payable currently to be riskier than debt that need not be paid for some time because the current payable requires the company to be able to access the necessary cash relatively soon. Not sure that's necessarily true for the creditor who holds the payable, though. I think they would rather, it's less risky to uh, have a current, well, your payable is my receivable, right, if I'm holding the debt. So if I'm the creditor, I would rather you have owe me currently than long term. But anyway, I see their point. So it says the long-term classification enables the company to report higher working capital and a higher current ratio. All true. All right, so just remember if you have a debt, long-term debt, and part of it's payable in the current year, you've got to essentially bifurcate the long-term debt into the long-term debt, the stuff that's not due until after the end of the current period, and whatever's due in the current period of that long-term debt, you have to list that as the current portion of long-term debt. Now, you could have what's called an obligation that's callable by the creditor. This usually happens when you've broken some debt covenant. And so, because you've broken a debt covenant, and I'm trying to think of an example of that. Let's say uh, they require you to have a certain debt to equity ratio, and exceeded, you've got too much debt. So you've exceeded your debt to equity ratio under the agreement. Um, Usually what they have in there is a provision that whatever debt you have with them is callable if you don't satisfy whatever covenant you've broken within a certain amount of time. If you have that case, even if you're not expecting the debt to be called, you've got to list it as a current obligation. Now, you could have a short-term obligation that you expect to refinance into a long-term obligation, when you have such a situation, you don't have to report that as a short-term obligation if two conditions are met. First, the firm must intend to refinance the short-term debt on a long-term basis, and they have to have the ability to refinance on a long-term basis. Well, how do you show that you have the ability? Usually by an existing refinancing agreement or actual financing prior to the issuance of the financial statement. So you've got to have something in place that shows you have the ability, not just the intent, to take care of this matter. All right, so that was part A. Part B is what follows, dealing with contingencies.